is basically sponsored and hosted by DueDash. Uh, and it is actually hosted by me. I'm the DueDash city leader, your host today. My name is Abhishek Kumar, and I'm getting help from my co-host. She is Miss Vandana Negi. She is the city leader for Sonipat. So I believe that you all know the agenda of today. Like as if you are a founder, if you are an investor. So there are some questions which goes through the mind, like and all of the founders want to raise funds at certain level, because when you start your business and at some point of time maybe you have bootstrapped your business, or you might have started with the help of your family and friends. But at some point of time all of us think that we need to go to the investor and we need to raise funds to go to the next level. So we have, a couple of, I would say, some personalities from the startup ecosystem, those who have gone through these phases. So please welcome our today's speaker. Our first speaker is Mr. Lev Migulitsky. He's from Kataki Ventures. Please welcome our next speaker, Mr. Nikhil Madan. He is the angel investor and entrepreneur, serial entrepreneur, and his mission is, to leave no investable startup behind. So, and please welcome our third uh, speaker as well, who's going to be joining us soon. I just got his message that he'll be a little bit late by 5 minutes. Mr. Mukesh Malik, he's the founder and CEO of Project GK. So today's session will be more on, what, when, and how. So when I was designing this event, right, I wanted to solve the biggest problems of founders, because when you start some business, you always think that when is the right time, right, for your startup to raise funds, right? And what are the activities, what are the pinpointers, and what are the gray areas you need to fill in, right, when you start to approaching investors for the seed fund, or probably a first round funding. And then what should be the preparedness once you want to go. So these all three topics will be covered today, and I believe that uh, we should start with none other than Mr. Nikhil Madan, who is an angel investor and helped a lot of startups, right, to grow and get onto the point where you can easily be make yourself investable. So Mr. Nikhil Madan, over to you.
Okay, thank you very much. Am I audible? Just give me a thumbs up if you guys can see me.
Yeah.
Thank you, Abhishek, for the for a very nice introduction. Appreciate it. Just a few corrections here. I've been not just an angel investor, but I've also been investing in certain funds. So that kind of have been in a bit more sophisticated space as well. But nevertheless, that doesn't mean that there are any issues. When it comes to investing, there are multiple problems that we've seen. So what I would suggest is, if it is possible, I would rather address, instead of having a unilateral speech from my side, a monologue. If I would really appreciate if Vandana could really throw up some questions which you see as part of, which are relevant to your fundraising process. That would be probably the best way to go forward, so that we're really addressing the needs of the people instead of a monologue. What do you think, Vandana? Sorry for this last minute change if this was not the format, but I was off.
I second that.
Yeah, go ahead.
So we can,
So
yeah.
take the questions, and I would be very happy to answer very specifically. So
Sure.
one little request: when somebody asks for, gives us a brief in terms of what is the stage they are at, how mature their product or service is, are they in the market, or they are where, at what stage they are trying to raise their funds and why, right? Okay, shoot.
So, first of all, we would like to know what is the right time to, for a startup to go for fundraising.
Hmm. So usually, I think there was a time when you had a bright idea, 20, you had some idea, you had a presentation file, you could go out there and you could potentially raise funds for your product. Unfortunately, that doesn't work anymore. Even if you don't have a product, you need to have certain proof points to be able to go to the investor and say that, yes, there is a demand in the market. And that's the demand which you're kind of trying to fulfill. So raising funds purely for saying that I have a bright idea and somebody should give me the capital to build it is unlikely to happen unless you've been a serial entrepreneur, or unless you have very high profile exits to your name. Yeah.
So, the next question would be, what are the
More
indicators?
questions. Indicators in what way?
Indicators, as in
Indicators in what?
the factors which reflect that you are now ready to go for funding, and now you are equipped with the investor readiness that we look for in any startup.
Uh-huh.
So, what are those indicators?
So I think, I mean, first of all, let us kind of, you have a product idea. That's why I said, when you're asking this question, at different stage, there is this, there are, every startup is very distinctive in its own way. And you need to recognize that element very, very clearly because, you know, something that works for someone doesn't necessarily mean that, somebody's trying to build a very extensive product out and would probably not be able to do through his own funds. So you need to first of all recognize where exactly do you stand at this moment. You need to prove, you set up your proof points. Now, what are those essential proof points, you could say? Uh, you had an idea, you go out there to the market, speak to random people who are potentially your customers, and ask them, do they want this product or service? If at all they say, hey, we want this product and service, we can't do without it, that's the time to go ahead and say, okay, I have a proof points for the investors, and I can go ahead, and there's a need for the market. So there is, this is called customer validation, somebody willing to build that, somebody willing to pay for your product even if you don't have the product. Alone a pitch deck wouldn't suffice. That's my personal view.
Yeah, so we have the next question out here in front of me. Uh, how much this is the question from Astro Balaji. Is how important is the customer validation for seed round?
More important than you can think. Way more important, probably the most important component in your entire fundraising process.
And sir, like if you can elaborate something like what are the ways that we our audience can understand that how they can validate the process of customer validation? Some quick inputs of yours.
Sure, I could do that. I mean, one of the best way is that once you have a product or a service idea in your head, break it down and say, find out who's your customer, define your customer persona, personality. What does it look like? Where they are present? Please try to avoid that everybody is my customer. That's the most common thing that I hear from a B2C scenario, especially in a B2C scenario, that, okay, everybody is my customer. That is just not possible. So you need to identify your customer demography very clearly, define your product or service very clearly, go out there to your demography and ask them a few questions. So there's a bit of a science when it comes to putting together a survey. Now get those first 100 people to talk to you, spend that time and ask them these questions, whether they need it or not. For all you know, we think we as a startup founder, we need it. Everybody would just buy it because I'm building it. Unfortunately, that doesn't happen. So go out there, find out from your customers, and most importantly, try and determine whether they are willing to pay for it, would be willing to pay for it. If it is the genuine necessity out of it, you would realize that you found that sweet spot even during this process, that probably what you thought out that this is what customers need, and during the course of your customer validation, you found out, no, this is not how they need it. This is what they need out of what I thought they would need. And that is something would already help you in terms of not making an expensive mistake. That would be my suggestion to the audience, whosoever wants to go out there for customer validation process. Talk to people, talk to people, talk to people, know your customer, know your demography, know your, your target market.
Right, that's great. Let's go to our another speaker, Mr. Lev. Lev, obviously, Nikhil sir has given some inputs on the customer validation. What is your point of view? Like how much the customer validation is important, for the seed round?
I think the sooner you can, and this is something that I'm going to address in my speech later on. I think, as Nikhil mentioned, customer validation should come at the early possible stage, because it's actually a direction you are setting to yourself, to your entire business. And when you set this direction, you can create, if you are not going to the right place, you can create an angle. And this is actually the place where should you test your entire business thesis. It's not just the product. Product, it's something that along the way could be altered in that way. It's the entire business structure, the revenue model, how much how much your potential clients are actually going will be willing to pay for. Is it sustainable for your entire business? So the sooner you are going to do it, the better for you, because this is how you'll be able to adjust at the much early stage, and not to put your entire research to the wrong direction. Okay, the sooner you are doing it, the better. This is a rule of thumb, if you want. And and by the way, Nikhil mentioned it. It's right. It's a constant business of checking yourself and altering yourself along the way with customers. Customers, for most, it's actually Apple's strategy. If you want to make it very simple. For most people, they don't have this perception. I mean, your target audience, they don't have this perception of something that is very innovative. You can have your product, let's say, okay, and you can give them the possibility to challenge it, to make what is good with this product at this current stage and what is not. This is the best way if you can put it in the market. You know, you can do like a minimum value product, you can do like a great presentation, but they should sense something. They should be able to touch something. So and then you can adjust, because for most just, you know, just a rough idea of something, it's not enough. So every place along the way you have to challenge yourself from the customer point of view, and not just the product itself, but the entire business. You know, your business could be built upon customers, other service providers, like your partners along the way, and you know, the entire structure of stakeholders. It's very, very important, and everybody contributes to the ability of your business to get as many risks as possible, by the way, for the entire ecosystem. And this is like very, very important for investors as well. Okay, but this is something that I'm going to address further. So, you know, to make it a rule of thumb, the earliest possible and along the way. Okay, it's like, it's never ending process.
Right.
Very right.
So thanks, Lev. That was a great insight, and it is our motive also as a team of DueDash, right? We keep doing these kind of activities, AMAs, and kind of sessions with experts to make founders understand each and every smaller details which is necessary for their growth out there. So I would like to ask the next question with our next speaker, Mr. Mukesh Malik. He's also
Oh,
here.
yes.
Welcome, Mukesh. Hope
Thank
you
you.
are doing good. So
Yeah, thanks.
the next question is from Prasad Jivane, right?
Mhm.
He's asking that, do we require to have a great traction to get seed funding? Very, very nice question, Prasad. I would appreciate, and claps for you that you have asked a
Right.
very valid question. So Mukesh, your views on this?
Well, I mean, it's practically an extension to what was asked earlier in terms of customer validation. What customer validation is required. I think for the benefit of the group, Lev and Nikhil have already explained enough in terms of customer validation. Traction is the subsequent step to it. One thing I'd like to, very clearly kind of put out to all the entrepreneurs also as well, that customer validation and traction is not an investor's need. It is a critical business need. So no business becomes, or no idea becomes a business until there is a group or community of strangers start paying for it. And then take it forward to the next level in terms of traction or the idea validation that takes place. There has to be a consumer or a customer or a client, whether it's B2B, B2C. An idea, mostly what we really get to hear is, it's my problem, global solution. And the validation and traction does not really happen going forward or going out in the world. So the larger the group of people who are validating and paying for it and buying for it, means that there is business to it. It is not just a laboratory solution. And let me define traction also for people, which is very, very important, especially for people in Punjabis like us at the moment and all. Because what really happens is, the moment I open a business, I will draw a WhatsApp message and send it to just my friends and family and say I've started business, and there'll be 300 people who will buy stuff from me just to show their expression of love. And that startup will keep moving around with the investors and saying, I already have 300 customers. So anybody from your phone book is not attraction for me. If you really go out, figure out, talk to strangers, make sure the strangers understand what you're really offering. It is critical to their lives. It is very, very important to their lives and making a value addition to their lives. They're willing to pay for it. That is where the real traction begins. That's why I keep emphasizing on the fact that strangers have to pay for it. Not my brother, not my sister, not my cousins, not my girlfriend, not my wife, nobody else. It's someone who doesn't know you, someone doesn't know the genesis of the idea, someone who doesn't really know where you started from, someone who doesn't appreciate just because it's your dream. It has to be validated by a stranger. And traction is most critical, as Nikhil just mentioned, at the early stage. If there is no traction, we'll again feel that there is a concentrated group of people only. So someone who's just buying stuff in Delhi itself and nowhere else. it's not really a scalable business for me to understand. Someone who can buy it, and I have a 3 city rule for understanding traction with most of the, or 3 client or a 3 city rule with most of the startups, that go to a city, if at all you're a B2C customer, go to cities 200 kilometers apart from each other and build a business there. Then when I see your idea is validated, or go to 3 enterprise clients and let them buy from you, is when I see, yes, the idea is really working well. Because it's not just the natural market, you're going beyond where you stay or where you're naturally placed. So that's something which is very, very important, especially at the early stage. Okay.
Right. That's really nice of you, Mukesh. Like, it was a great insight actually. People are getting out here. And the next question, which is coming, I will go back to Mr. Nikhil Madan. Right. And this question itself shows that we have, a lot of founders from different domains. So one of the founder, she is a lady, Achal Andrews. She want to ask that we are an NGO seeking fundraising and also have an L&D for profit model. Our question is, what is the sensitivity to a topic like prevention of child sexual abuse for funders? What would be what would be required to realize the funding from a venture capitalist? So it's a very nice question. I would like Nikhil sir, to give the answer for that.
So I think this is where you need to know your venture capital's thesis very well. Now, every venture capital firm works within a certain boundary they define for themselves, where they are going to invest, how they are going to invest, at what stage they are going to invest. So to be able to say that, every VC is going to jump on this idea, not necessary. It's not going to happen. It's very, very unlikely. So there are specialized venture capital firms, which are called social impact firms or social capital firms. There are different names. They operate under certain 3 or 4 different names. You need to identify those and only address those, because you can't spray this across the VC landscape and say, hey, you know what, I'm doing I'm an NGO. No, fundamentally, just remember, VC business is designed for big hits, and social impact NGO, uh, even if there's a for-profit model in that, it's not your typical venture capital model. It's not going to go. It's usually very, very geographically limited, often, or there can be some global themes, which are currently, I think, one of the ways to identify where you fall is there are United Nations 17 SDG goals out there. If you fit into one of those goals, you identify investors who are specifically addressing those goals, and that's the place where you should go ahead and talk to them. So not basically, your answer is not, this is not a general VC problem. It's not going to happen. You're going to be wasting your time if you try that.
Yeah, that's great.
Probably you should take a reaction from it as well.
Yeah, I want like most of the audience, those who are there, like they are founders. So if you have any questions, you can put it in the chat box. Meanwhile, I will, get back to Mr. Mukesh Malik and get back to the basics of today's agenda, which is when, what, and how. So Mukesh, I would like to ask, as you're a founder and running near about say 10 to 11, different setups of business streams. What are the indicators? Like, what are because when we start as a founder, because I myself started and being a part of, some startups earlier. So
Right.
what are the indicators, the right indicators are there? So we can say that now this is the time we should go for the fundraising, because as a founder, as soon as we incorporate a company or having a good team, we all of us start thinking that we are ready to raise, and we start getting into investors network, or there are so many angel networks and angel investors, those who are there, right? So we start approaching them. So I would like to know from you that what are the right indicators that we should start approaching to the investors.
Okay. See, first of all, it's a human tendency. We never feel that we are not ready. I mean, to a point, even a 2-year-old kid at home would snatch things from you and try to do things all by themselves. I mean, that's what is going to happen. So we've always felt that we're ready, which may or may not be true for someone else's perspective. See, first of all, funding and investment from a third party, it's a mutual perspective. It is not a singular perspective. You just cannot really go out in the market saying, because I think I'm ready and I should really get the money, then go get the money. It's as simple as that. I mean, most of the times when I ask the question that is your family willing to invest in you, they say, no, my dad doesn't listen to me, you know? So if people that you live with day in, day out, I know that sometimes they do take you for granted, but if you're not able to build that faith and confidence with people who know us well enough, investment is a confidence building exercise with a stranger. Again, I'm coming back to stranger because business associations mostly work within strangers because at least there's a clarity of scope and thought and work that we really want to do. So in terms of readiness, it all depends upon what kind of need that we have. Most of the people don't even understand the difference between funding and financing. So many times all they need is just financing. They don't need funding. Okay, I'll come to that probably. I'll take a minute to reach there too. So the most important point that you really need to look at is what exactly do you need the money for? I mean, so many times even founders need money to even incorporate the company. Forget anything else. I needed it when I started it, all right? But I just cannot really have someone else be responsible to incorporate the company for me, and I cannot really go out and ask for money for that. So the indicators for me is whether my idea, again, I'll go back to the same point that my idea is business worthy or not. Can it really become a business? For me to be able to figure out whether the idea is becoming a business is where people are buying from me. People understand what I'm trying to sell. Because as you said, so many times, I mean, I'm sure Nikhil and Lev both will, understand the fact that the pitching starts from कि मैं रास्ते से जा रहा था, मुझे एक पत्थर मिला, I thought it's everybody's problem, not just my problem. And let me remove the stone from the road and it's a million people's problem and I'll become a millionaire straight away by solving this problem. So first of all, we need to be able to understand if at all we're reaching out to the market in the right way, or is it really big enough a market for people out there or not? Founder to be able to understand that, see if the product really fits that market size. Second, what exactly is my money requirement? Do I really need money only to fulfill an order? Not to just grow and build a team or build a product or something of that sort. Then the financing would do for me. Financing is a transactional handshake of money between two people. You'd simply say, okay, you have a project, it's a 20 lakh rupee project, we'll make 30 lakhs out of it. Let's divide half and half. You execute the order, I'll sponsor 20 lakhs to you and we'll finish the deal and we'll go our ways. So that's a simple financing transaction. You don't really, are not inclusive, you're not part of the company, you do not give out a portion of your company. So that is what it is. But financing, one thing's for sure, that it is mandatory for you to return the money, which may not be a part of funding, which I'm sure Nikhil would have a smile about, or Lev would have a smile about also as well, because startups do not really know that. Funding is when you become inclusive, you become much more inclusive, you have someone to participate in growth with you, someone who would bet on you, someone who would want to be inclusive with your company, who's not asking to pay his money day in, day out, who's not looking for interest or dividend tomorrow itself. They would simply say that, okay, grow this company, let's grow it together. I know I will get my money out of the growth of the company, not just by one single contract. So that's funding. Example of funding is that your parents funding your education to build a product out of you. The other example of financing is they give you money for a party, you finish it off, right? So this is as simple as I can be in terms of let people understand in terms of what financing and funding is going to be. So my indicator for funding is going to be that, okay, if at all it's a financing requirement, I will approach financial institutions and get the financing done. So if at all I have an order, I'm sure everybody who's building a product will tell you that, sir, there are 10 people waiting for this product to be completed. They say they want to use it. They want it right now. They want it tomorrow. So if they want it tomorrow, we need ourselves to be production ready. We just need money for that particular part. That's financing. We'll do that. So pick up financing only for the execution of order. But once you know that you need money only for growth, not to pay the salaries, not to just run your operations, not to just survive. The moment you simply start picking up money for that, funding will not come your way. Because if I have to fund an operation, I would rather fund my operation rather than third party's operation. All right. I would fund someone's growth. So the day you are ready for growth, that's the best time that you should go for money. That's the best time that you should go for funding. That's the best time you should go asking for money, because you're asking for money, growth, not for sustenance. And trust me, investor will understand whether you come looking for sustenance or you're looking for growth. They will understand that very well. So that's one big indicator that you know that your market is validated. There are people asking for you. You can grow to a different city. You can set up 10 more franchises. You can set up 2 production centers, or you can actually enhance your application, or you integrate AI or something into the application. So many product feature enhancement, you can really get money for that. But if you say that, sir, my company mein to nobody got salary for last 3 months, I need money right now, and fund that, I am not too sure everybody will be too excited about that particular prospect. So the biggest indicator is growth that the money requirement could be. Second, your distinction between funding and financing. That's very, very important. Third is when you know there is an investor who can bring in a lot of other strategic advantage, whether it's a market, whether it's a client, whether it's people, whether technical expertise altogether. So many things. So that's the best time that you should go for money, because I meet so many organizations who reach about $1 million revenue. But sir, they keep saying, sir, we're just banging our head against the wall and we don't really know how to go to 10 million from here on. We have no idea about it. So one investor with a perspective or a market connect or a technology connect or another thing that they can bring, and that will just multiply their growth like anything. So without taking too much of time, I would say these 3 are good indicators for anybody to understand, to start where the money should come from and what kind of money should come to them. That's very, very important. So what kind of money and when? These are 2 critical indicators in very simplistic language, if I'd say. That's what it is.
Right.
Abhishek, I think you are on mute.
Thank you.
On mute. Abhishek, you're mute. We just can't
Sorry,
hear you.
sorry. Yeah. We have a next question from Sumit Datta. He's from Bangalore. He want to ask something to Lev. So Lev, this is the question from Sumit Datta, Bangalore, for you.
Hey, Les,
Yes.
I'll just keep it short in line to the validations and stuff that people are talking about. Considering the global trends of cross-border investments, I would like to know what's your take on evaluation metrics beyond geographies, specific to non-technical products or service-based startups. Could be for scaling their operations, could be for global customer servicing, could be for production accelerations, or for building affiliate markets. How would you validate that for cross-border investments? Because we see that right now a lot of people are into cross-border investments as well.
Yeah, right. So first of all, as already been mentioned, I think by Nikhil, there are venture capital firms with a global perspective. Okay, so they are quite proficient in doing global finding and can actually evaluate your business without any geographical constraint. I mean, there are some different valuations when you think about startups from Silicon Valley to even in Canada, there are different approaches, and in Israel, in India, and New Zealand. Okay. For example, Kitaki, which I'm fortunate to represent, or at least to lead the Israeli angle for Kitaki, is my partners are from India, but our registration in New Zealand. So we are actually dealing with it all the time. So it depends pretty much on a stage of a startup. For most, you will find high valuations. We're speaking about silicon or US based startups. and it actually goes lower to when you are moving from the Silicon Valley area. And but at the end, it's once again it's about a stage, because at the early stages you are thinking about valuation when for most there are no rules. I mean, there are some, rule of thumbs that are actually shaping the best practices. And when you are at the late seed stage, for most deep tech startups would be evaluated at the same plus minus at the same level. And I can throw some numbers, but I think it's less relevant. But when you are moving to the much advanced stages, the only thing which actually will dictate your evaluation, it's your figures, it's your numbers, it's your sales. Okay, and then you are going to move actually to a pure economical evaluation. I mean, to economical models that will structure your entire actually worth. And it doesn't depend on what country you are coming, and when you're targeting like global investors. Okay, so it's once again, it's pretty much depends on your stage. On your field, some areas like let's say deep tech, it's at least this is like our major topic. Those are those startups falling within this field are could be pre-revenue, even up until Series A funding. Okay, so it would still be in a level of what's the proper valuation for this particular stage. So it could be somewhere in about 7-8 pre-money million of dollars pre-money valuation, up until like 15. This is like the common boundaries with Silicon Valley. When you will move like to the Europe, Middle East, Asia, it will probably go down a little bit, not necessarily for too much, but still this is like at least from my experience. But at the end, your stage will contribute to the valuation. Your exactly place, I mean, whether you're in health tech, in ag tech, in deep tech, whatever. When you will go farther along your growth curve, it will actually, those like general numbers will be less relevant. What be relevant is only your actually monetary figures, like how much you are selling, what are your real numbers, not just projections. Okay, projections, it's very, very interesting, but at a later stage, your real numbers, this is what will going to shape actually your valuation. And I think today there are like huge amount of global investors when can serve great value for any venture targeting like global expansion or global networking, and they are quite professional with everything needed, to have this, a tag of price which you really worth. So you don't need to like worry about it. Okay, but there are some differentiation between like US or Silicon Valley, because this is like the different it's like 180 degrees of differences when you speak with Silicon Valley venture capital firms who evaluate you, or when you're going like to Asia. Okay, it could be like this is the largest possible gap in terms of actually thinking about evaluation. But the truth will fall somewhere at the middle. Abhishek, I think you're still, yeah.
Thank you. So thanks for your answer. And Sumit is also saying thanks to you. My next question is from Akash Mishra. he wanted to ask Mr. Mukesh Malik. He has given a scenario where he's
Right.
saying, let's take an example of a startup which has
Mm-hmm.
identified the problem statement. Did the
Mm-hmm.
customer validation with the identified target segment, build the
Okay.
product, but require capital to launch in the market? How would they go about it? Yeah, Mukesh.
Okay. Depending upon what the validation size it is going to be. So first of all, let's understand the fundamental need. Is it only to reach out to market, or you just need to have money to reach that market? So there's so many people who feel that the moment they get money, they will be able to invade the market and win over market straight away. Uh, from my experience, with more than 500, I would say too close to 1,000 startups I met over the last one year, 1.5 years or so. Most of the product guys are not the best production engineers. Okay. Similarly, most of the product guys are not the best marketeers also as well. So are you looking for that capability is going to be another question. So if you're looking at a market capability, then it's best to figure out an investor who actually already has a great market penetration and who's already funded certain startups or organizations which are complementing this startup, which has validated the idea, which is already has customers and wants to reach out to market. Then go for a strategic investor, not for the full money, because you may not be able to, it's not a testimony of your capability of handling scale, if at all it comes to that. If there is market invasion happening at an enterprise level and it's from order to order also as well, I would say go for order financing, and there are a lot of bill discounting measures that are available also as well. You can really go out and simply say, okay, I have about $20 million or a $1 million or $2 million order. I just need some banking support for me to be able to execute the order. That's where the market invasion may happen. So that could be a different scenario to pick up money from that particular perspective. If we have a product, if there is a market validation and the product is selling well and being perceived well, you already won half the battle. Your business case in front of any investor is very good. But the point is, a founder or a team needs to have clarity in terms of whether they want that capability or whether they want money to build that capability. Is going to be the fundamental question where most of the people miss out. They don't really look at that. They simply feel money will solve all their problems and they have inherent capability to win over anything. As you said, we always feel we're always ready. I mean, I'm ready to play for India today in terms of cricket whatsoever. I can always pick up a bat and swing my bat. But the readiness requirement is very, very different once you go out there on the pitch. So that's something that you need to understand. Fundamentally, understand whether you need market capability or whether you already want to have money to build that market capability. These are the two differentiations primarily. I hope I mean, you want me to give it in further real life example? I can do that too. It might eat into your time, but I could really give you real life examples also as well.
Not a problem. We would like to, listen.
Sure.
And that's why we have, entrepreneurs and the people, those who have, experienced all those things.
I'll give you an example of a scientist who built biofertilizers, spending 20 years of his life building that biofertilizer. All right. Started the business. How do I know it? Because I'm invested in it now. So so that's where I'm kind of coming in. So he started with that particular business. They did about $1.5 million in the first 2 years. Business went really well. Great market validation. He realized that nothing could stop him. But there was no corporate governance, no structure internally. He lost purely on recoveries, no real collection mechanism, identification of what distributors will work for him and what will not work for him. The company went 4 crores under in the third year, right? So we not only lost this 10 crores that was being made, 4 crores further went away from the pocket. And then I kind of dived in. That's the time when I had joined in. And I had to reorient and change the whole model altogether. So we moved him to a different marketing model, partnerships, certain bodies which sell, because there's a better control on collections, there's a better control on how the product will be marketed and distributed, how will it be sold and all. So now there are about 5 different production franchises being sold in regions across the country. The business is already moved back to more than $2 million. There is a 1,600 ton worth of fertilizer enterprise order that is in place, which is really being worked upon. So my induction was not just for the money. My induction was to be able to build that, because I headed rural for ICICI Prudential. I headed strategy at that point in time. So I understand rural India fairly well. So I could really use that particular expertise to build that kind of network that we really needed to. And now the company is growing. We're looking to go to 3 different countries next year. So that's where the model grew. My scientist, Dr. Saab, is still a great product guy. But the moment I send him to field, he tells me, Mukesh, I don't need to be there. You do it and deal with it. So that is where it's really requirement, where most of the times we feel that because I know the product really well, I would know the market also very well. That's not the real hypothesis that really comes out to be. This is a real life example, which is coming from my own life. I'm giving it to you. I can give you 5 more. Out of those 11, 12 companies I'm part of, there are about 4 or 5 more such examples that I can give you right now. But that's how it works.
Yeah, that's great. Like as we are, moving forward with the, the session, and we have a lot of entrepreneurs, I would say, and a lot of founders, those who have, at the ideation stage. So our next question is for Lev from Ridwan Oladipupo. He's basically a founder, and he's saying that our product is not ready, but we have customers who dropped their contact with us. They said we should call them when it is ready. They are willing to buy. Is that a traction? Lev.
Look, I can only address this question with my personal experience, and let's do the following. If we could go like 20 years back, so even you probably know it at least as good as I am. You could raise money even with a PowerPoint presentation. Okay, today it's not necessarily working this way. With customers are willing to pay for a product which is actually is not existing. It's kind of it's still it's still a risky business. Okay, first of all, this is quite good to have what it's called letter of LOIs, okay, letter of intent from a potential let's say from a potential customers, which states that he is willing to buy a certain technology. Okay, this is great, of course, and for some it could serve as a good perception of trust. But you should be very, very, careful about it, because a letter of intent, it's not necessary, it's not like they're willing to pay in advance. It's not necessary, this situation. And when when you'll be on when you will finalize your technology, for most, and this is actually what I came across to with companies got this, like 10 letter of intents, 12 letter of intents, and like, I mean, 10, 12 enterprise customers who were willing to pay for a certain technology. But when this technology came to this, point when there is a product, those customers actually took back, because this is not what was their initial thinking about this entire technology. Okay, so actually from one point of view, it could be served as a traction. Okay, because it's early sign for willingness to accept, and of course to pay for the product, but it should not fool you. Okay, letter of intent or any other intent states, because at the early stages, nobody, unless you've got this check and you got the money, and you're actually, as a service provider for a grown-up company, somebody paid you like 50% in advance, and then you're building something for them. Okay, it's a completely different story. Okay, so you should be very, very conscious. It could be counted as a traction. Okay, and the more you have, the merrier. But it's the gap between this actually be your really customer at the day when your technology would be ready. It's not necessary that. Okay, so What I would like to suggest is, yeah, to have as many those kind of letters, as many as you can have, but then to continue, warm up those potential clients, to to mirror your progress. I mean, to emphasize your progress, and to make them be to the, when you're coming with commercializing your product, they'll be at the same level of enthusiasm, of still be willing to buy from you. Okay, because for most, those letters are useless and worthless, because they're not like, it's not it's an intent. Okay, same with investors. Okay, unless you have the money, unless you have all the documents are signed and restricted to particular law, it's everything could happen. Okay, and this is the business. Very, 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 very tough business. Okay, so yes, it is attraction, but it should not fool you around. Okay, it could, like, at the right moment of writing the checks, everything could happen.
Right. Thanks, Lev. I believe Ridwan might have got a insight on his question. My next question is basically from Mr. Nikhil, Mr. Nikhil Madan, because it is related to something like, investment and the pitch deck. And I believe that as he has already written, some checks to some of the founders earlier as well. So the question is, what are the typical KPIs that an investor looks for in the pitch deck? Yeah, Mr. Nikhil.
So, I mean, again, I'll go back to, first of all, clarify one thing. And I think it's a very important point which Mukesh made earlier. Do you need financing or do you need funding? There are two fundamental difference. I think those, once you've clarified that, then I will come to the KPIs. Now, typically, the KPI is different. Again, it depends on the type of business you are running, whether you're tracking your monthly recurring revenues, what's your annual recurring revenue, what's MRR, ARR that is called, and what's your burn rate. I think how much money do you have to be able to sustain for how long? That's also called runway availability. If there are any cash balances, in case there are some interim financial requirements, how will you fulfill them? Those are then LTV, customer acquisition cost. Sorry, I can't really, calculation of actual customer acquisition cost is very, very critical. What is the cost at which your customer comes to you and how long they stay with you? So that's called the LTV, the lifetime value of the customer. And I think there's another aspect of it. There's how many of them will drop off during this journey. That's called churn. I don't know if how many of you are on the DueDash platform, but we keep, checking. We keep asking you these questions as part of our journey. Also, I'm sure there's a lot of polls and questions that we keep raising. The whole idea is we are also capturing our own metrics, KPIs. So the last question which was there was around net promoter score. So how many people who are willing to promote you and how many people are detractors who are not, who will go either ways. So those are the potential customers or customers you need to really look at. Then of course, what's your employee growth and how your customer is growing, how your customers are growing. What is also critical is that in case these customers, how is it that you're going to bring them back if possible? How do you retain them? How do you control your churn in terms of personnel? So most of these elements are very numerical in their nature. These are called vanity. And then of course, one thing which I forgot, that how your community, your market as Mukesh said, people who don't know you perceive you as a business. So these are like, you know, vanity metrics, which are very, very critical. Like, you know, how many new people are signing up, how many are they retaining, how many you're retaining, how many times do they come back to your website or product or application, and how much time do they spend on it. So there could be like tons of it. The more they are, and as long as they are relevant to telling your data driven story, it doesn't matter. But you need to decide, you know, how much and how many are relevant. And as again, this is very closely tied to the type of business you are doing.
Yeah. Thank you, Nikhil sir, for your insights. Like as the session is moving on, I believe that we have spoken about when you're ready and what are the indicators to raise funds, and we have spoken about what other things you need to do. Now let's move on for the how part. Like uh, most of the people, like when we think that we are investment ready and we have certain fractions out there, we have we have done our customer validation. So most of us are confused that how we can, from where we can start, uh, the fundraising journey out there, and where we can, so I would go back to Lev out there, and so I would start with Lev. Like, what are the insights Lev would, give to the founders that to, wipe out the confusion of how I can raise funds for my startup.
Yeah, sure.
Lev.
I will address that. If is that okay? If I will share a presentation with everybody.
Not a problem, Lev.
Yeah, if the host, if can grant me this, this. Um,
You want to share your screen, right?
yeah, I would like to share, but the host should grant me this option first,
Mm-hmm.
and then I will. Uh, I mean, there are just a few things that would be much easier later on for everybody to remember. So this is actually yeah, maybe someone from DueDash. Who is the host?
Yeah, I have given the permission from my side. You can start.
Ah, great.
Yeah.
So just tell me that everybody sees the presentation.
Mm-hmm.
Great. So I will share. I will share it later on. It's of no commercial secrets, although I think I will really reveal a few ones. Yeah. So once again, thank you for the opportunity to participate here, and I'm honored. I'm an Israeli-based strategic advisor for startups, and for the larger part of my relevant experience, I was on the sales side. I was leading actually a lot of startups, a lot of founders on their fundraising path, and now I moved. I'm still doing it, by the way. Now I moved to the buy side with Kitaki and with great partners from India, and. When there's a when I was actually on the sales side, the challenge was to understand actually all the decision on the decision, what is the decision journey when I target potential venture capitalists? How do they decide? Because I wanted to be very as a person of strategy, I wanted to be very precise, to actually to structuring this, even the verbal sentences, okay. And and this ability to crack the rules of the game, it's quite challenging, okay. So but after I think I went through to a significant amount of these kind of interactions with a lot of failures, with some successes. And today, when I on the buy side, I think the rules of the game, it is something that are much clearer to me, and I would like to share it. So I structure all to this model I call the P&L, okay. And this is this is something I brought to this presentation. So, but it's actually, I believe, telling the entire story. So, and the P&L, I will address it later on, but this is actually something that, it's a P&L stays for the, profit and loss, but later on we'll speak about it. So I would like to go through this presentation, hopefully to meet, 10 minutes, 12 minutes. So first, I would like to address this quote from Albert Einstein: "Everybody is a genius, but if you will judge a fish by its ability to climb a tree, it will live its whole life believing that it is stupid." Okay, I didn't say that; Albert Einstein did. So, and when you think about this quote from our perspective, from the perspective of our today's session, it is quite fundamental to understand. When you're pitching your startup, there are at least two lines of perceptions. This is your line as an entrepreneur, as a CEO, the way you believe in your startup, the way you judge your startup, from your entire point of view, or from the point of view of your team, okay? And there's the way your potential investors or the entire ecosystem perceives your startup or judge your startup. Those are, and very crucial to understand, those are actually parallel lines, okay? Because for most, the tools which potential investors use to judge you in each and particular situation are different tools from the one you use when you judge yourself, okay? And this is bring us to the fact that actually, you have a great tech and a great team and everything, by the book is perfect. And you actually Google for this Silicon Valley pitch deck, okay? Or you went through all these, by the way, my advice, it's free stuff. Do that, Google for that, because I still get pitch decks which are bad, very bad, and actually are not fulfilling this, basic criteria of giving me, the minimum information I need to make the judgment. So so they Google and they have all these things they're addressing in their pitch deck, and everything is quite structured and quite good. They have problem, solution, market size, whatever is you can see here. And not necessarily you need to target all of the issues. Depends on the stage you're in, and of course the attention you are giving to each in particular point. It's not necessarily the same attention, but you are still you think you are quite good, and then you have this big no. Okay, and it's quite frustrating, because you think that you're coming with a genius idea, and you actually did your best to address all possible points, and then there's this no. By the way, for the lucky of those who actually got the feedback, okay? And I must say, and I want to everybody to feel quite confident. For most, it is not that you could have really great tech, okay, and your pitch deck is a precise one, okay, I've seen many of these. But I also seen startups at the very, very seed stage with like one pager or 1.5 page of actually explanational, know me document, were able to raise some money. Okay, if it was needed. Okay, but for most, I've seen like brilliant ideas with brilliant pitch decks, okay, who could not raise. And the big question is why? And the funny thing is that for most, everybody following the right rules. They just don't understand they're playing in the wrong game, okay? And this game of understanding the capital ecosystem is quite important. And because the internal game, which is going, behind the scene of a venture capital firm, and the entire process of making the decision within the venture capital firm or any other, angel group or whatever, it's a game that for most nobody will reveal. Okay, but at least some of the things I would be able to address for people actually not wasting their time on not on wrong things, but to address the right things. Okay, so I brought this P&L model, which goes for a process, network, and language. Okay, once again, it's just for your convenience to remember it in the most easy way. Okay, and the pillars are process, network, language, and I took this like three points for each, so it's like 9 points to remember, and hopefully it would easier your path to raise money. Okay, so let's start with the process. When you aim to raise fund, doesn't matter what state you are, you should address it as a strategic process, not a tactical thing. Let's write a pitch deck, I need this and that money. I was very, very happy to hear from Nikhil and Mukesh the fact that this understanding, this very, very thin line of understanding the difference between funding and financing, it's crucial. It's crucial. There are like 20 different capital tools for financing. It's not necessary you need to sell your company for equity. Okay, you can take a loan from a bank. You can go debt funding. Okay, you can mix whatever. But the process, it's a strategic process, not a tactical thing you do like right now. And it's an endless process. First, I think you should think backwards. Okay, you're thinking about your tech. What you are aiming. I mean, what's your end goal? You want to do an exit? You want to do, what kind of exit do you want to do? Okay, who is the one who are more likely to buy your entire business at the end? You should go from the end, okay, backwards, because along this way you'll find and you'll be able to map all those stakeholders who you be able to help you. Okay, it's not just the exit part; it's also growth stage funding if it's needed, like okay, Series C, Series B, Series A. Okay, those are different players along the way. Okay, create demand. I was very, very happy to hear that my partners here address that. Revenue is the most right way to finance your business. Okay, every proof of concept, okay, even if it's on an early stage, it could be like free with no money, but later on payable commercial trials would follow. Okay, create demand. Okay, demand customers, clients, traction, much more important. I see a lot of entrepreneurs who are running for funding, not necessary funding. They're putting their entire energy or on things which are not necessary. Clients are what is necessary. So at least put your like half of your enthusiasm or on finding customers for your business. Continuously improve. There's no I've gone through some you know I've seen a lot of entrepreneurs who from their very first pitch to the like 20 speech, they didn't change one thing in their pitch deck. It's wrong. You should address each potential investor and each potential venture capital firm. They are all different. Okay, you should, first of all, you on your learning curve. So you should be from each pitch deck, you know, from each interaction to the other. You should do better. You should alter. The same way when you're, you know, looking for an employment position, okay, you should alter your CV, okay. It's not like one suit fits all, not at all. It's a wrong, it's a big mistake. So you should be continuously improve your pitch deck and alter it to each and every possible venture capital, because even the fact that let's say you are with a health tech. Okay, there are different health tech venture capital firms, okay, or angel investors. Some understand in digital health, some will never touch everything related to medtech, and those solutions who are very high regulated. Okay, so they're like very, very different. And with biotech and pharma, they're like it's a long shot, very, very long shot. So they're all different, and different things are actually shaping their entire judgment system. Okay, so this is from so this is for the process part. Think it from the strategic point of view. Network. Your network is your net worth. Okay, it's the ability actually to leverage all the people you know, all the people who surrounds you. Because in each particular moment, there will be like one person who will do the entire difference. So map your stakeholders, okay? From the end, you know, go backwards, and from the end to the beginning, map all your stakeholders. You targeting with your solution particular enterprise, let's say customers. Who are their customers? You can actually approach to their CEOs, CTOs, whatever, and try build relationship before you even trying to sell them something. Okay, those all your stakeholders map. You should be very, very clear about who are the people who can surround you and can leverage you. Make them be involved. They all should be on a mission. Okay. You have this initial traction, you have this very, very seed stage tech. Go LinkedIn, okay? Find this whatever the persona within a particular company who could be potentially your client. Send him a message. Ask his opinion about your possible, just general opinion, okay? Make him to be your friend. When you ask for help, it's not from a, it's a good thing, for a good cause. People will be willing to help you. Each point of view, it's could be very, very valuable. Okay, give and return. Sometimes it is better to have like 10% in a very, very, very good business rather than to have 100% in a zero business. Okay. So some people, okay, there are like some professionals who will surround you, some other people who you will be able to acquire as a partners for your business. Okay, give them in return. Okay, you know, it's a good thing, because you have to, you know, with good people you can achieve more, and it's okay to give them. I don't know what to give. I mean, it's about your business, but and some must say, okay, but you are pre-revenue, you don't have money. What you can give? Think about partnerships. Think about like a few percentage from equity to people who can actually be very, very valuable. Give them, because you know, time, it's the resource that we lack the most, and some people you will meet along your way are the ones who will actually be very, very valuable and can be able to do these shortcuts. Those are, you know, those has like very, very huge value, and there be it is a good thing to have those people around you. Last but not least, language. When you do your pitch deck, so at the beginning of this presentation, you've seen most of the things you have to you know, to address. You know, at the end, most of the good presentations are very, very alike. Most of them are similar. So it's quite you know, sometimes it even, and you'll have to excuse me if I will use this word, but this is actually a very, very fundamental thing when you think about the internal game. When I get this pitch deck, and it's actually makes me be in a very, very boring situation after like third slide, not good, not good. So frame your pitch, okay? When I say frame your pitch, it's not just when you use your pitch deck. I mean, with every introductory email, with every like know me presentation, with every interaction, frame your pitch deck. What I mean, when you go and you read newspapers, so there's an article, and with every article comes like a headline or a subject line, okay? This what actually shapes your understanding and give tools for your judgment, okay? When you frame your pitch deck, you give the precise tools for potential investor to judge your entire project, your entire business. Okay, I had the chance to lead one agriculture company, and they're like every time we actually engage particular, you know, stakeholder, whatever, we said this for the last 60 years, like 60 for the last 60 years, this and that particular business didn't change, and people are getting their decisions with when they are blinded. Okay, so this is actually structured your entire understanding here, that because if a particular business didn't change for the entire 60 years, wow, okay, it's interesting. So what are they doing? Okay, so it actually shapes my intention to it. Later, make it stick. When you pitch to a particular partner, let's say, okay, he's not the one who's going to decide whether to invest or not. Okay, there will be an entire process, and then there will be like a investment committee who will decide. But this person, you should put him be on a mission. You should give him tools to tell the right story within the company, within the venture capital firm, because later on he has this deck. It's you know, I would be surprised if in many interactions they will all see it and go through the entire deck. They're all like, you know, they're busy people. What you need one thing that would be sticky enough that this particular person will say to his internal partners, look, I have these guys who are actually reshaping the entire, and you can use here like superlatives, okay, as long as you can deliver, okay, at the end. This sticky thing is something that this person will take and later pitch internally, okay? It should be very, very precise, very, very sexy, very, very big, with like a huge promise, but of course it should be truth. I mean, okay, it should be not. And this is the internal story, the internal storytelling he will later go and say to his partners. Mirror the interest. You know, sometimes, you know, I can speak about the venture where I'm partnering, Kitaki. So it's a certain amount fund, and actually, when we judge particular opportunities, each particular opportunity, we actually we can we do the projections. Let's say we will invest, and then it will go through several milestones, and at the end of the road, we will end up with a certain possession. Okay, we'll have certain shares within this company. Okay, whether it would be enough, okay, to make a good ROI. Okay, some niche markets or some markets would not be like big enough or interesting enough or attractive enough for companies to invest in, because they're not meeting you know, the minimum amount of ROI for the fund to actually to go into. And it's not because the business is not good. The business could be like wonderful. Okay, it's this thing that and this is how for most okay, venture capitals think potentially for each investment, I have to be able to bring at least the entire principal of my fund, because I will have my portfolio of 14, 15, depends on a company investment. Okay, maybe one or two of them will do a great exit. Okay, so potentially I have to target those who will able to bring the entire principal. So this is, if I can mirror that, if I can show through the entire deck that actually my market is big enough, and I have all this strategy that makes me, that lowers your risk, you as an investor, it lowers your risk to participate, and you can do a great business with me, this is when he will follow. Okay, so it's all about economical approach. Okay, because this is, and you may have a great deck and great technology, but for most of the investors, and you know, it could be frustrating. I know, but this is the rules of the game. You should speak their language, because you have to see those seeds in their heads, that this business of mine is economically worth it for you, my potential investor. Okay, and I know exactly how to do it, how to lower your perception of risk, and how to make you a very, you know, rich at the end together with me. So it's and it's quite a process. Okay, and just to wrap it up, P&L stays for profit and loss, and for all of you it will be like easy to remember it. Okay, at the end it's all about the numbers. Okay, profit and loss. This it will make you this model to be very understandable. Profit and loss. It's all about the numbers. Show me the money. Okay, even if the market would not be like a 1 billion market. Okay, if I will be perceived that this particular business, it has the right metrics, the right numbers, I see it's solid, the management can actually provide a very solid business. So I know maybe it would not be a unicorn, it will be like a quarter of a unicorn, but it's still a worthy business, because the numbers, it's actually showing it. Okay, and I will need those proof. So I think this is it, and of course, you know, the process. Just one more thing, you know, the process is very important. It's a strategic process. It's all about your network. Okay, some people will have an extremely high value of helping you to achieve your goals, your whether it's a financing goals or funding goals. the language is crucial. It's crucial. Language is, you know, all those little things with structuring your pitch, with framing, you know, you can frame your each and every single slide, okay, gives the right tools for potential investors to judge and to have the right perception about your project. So this is from my end. I think I could cover the subject.
Yeah, that's so nice of you, Lev. Very nicely explained, and I believe the people, the founders, those who are there on the session, they would get benefit out of your presentation and the insights which you have given. And we are really short of time, so probably I will thank to all of you, those who have joined our session. I would like to thank Lev, uh, Nikhil Madan sir itself, and Mukesh as well, that you guys have given your time and made this session, very worthful, like the way we, designed the when, what, and how of fundraising. And I would request to all of the audience out there and the founders, those who are having the entrepreneurial mindset, right? If you want to know more and a kind of join a gym where you can do exercise of different related to startup ecosystem, you can join our community, which is I have already shared the link, that is community.duedash.com. Moreover, if you are in Delhi, so you can contact me. My name is Abhishek Kumar, and I look after, I'm the city leader for DueDash Delhi. So if you want to any kind of help in terms of growing your startup, in terms of raising funds, or connecting with the right people in the ecosystem, you can reach to me or Vandana. She is also from Sonipat. She is looking after uh, Sonipat. She's a city leader for Sonipat city. So you guys can reach us anytime, and we are there to help. Once again, I would really thank all of you to come on the board and give your time out there, and we will be keep coming with a lot of insights on fundraising and other startup tools which are there with us, and most of the things you can find out on the platform itself. So thank you, Mukesh sir. Thank you, Nikhil sir. Thanks, Lev, for
Thank
your
you.
time and the valuable insights which you guys have given. Thank you.
Thank you. Thanks for
Bye
having me.
bye from
Thank you.
now.
Thank
Till
you.
next
Thank you very
time.
Bye-bye.
much.
Thank you
Thank
so
you.
Yeah.
much.
Take care.
Bye.